The unique characteristic of the current crisis is how it was triggered, essentially by a government decision to shut down economies to contain the spread of the coronavirus. Going into this recession, policymakers were in easing mode, primarily in the US and also in China. So unlike previous recessions triggered by a tightening of policies, this one is starting on the back of easing conditions and unprecedented policy intervention by leading governments and central banks. These administrative measures of confinement and shutdown of important sectors of the economy have led to depression-like declines in GDP activity. We're talking about year-on-year 15 to 20% in leading economies decline in economic activity compared to last year. The ability to recover those losses of output will be critically dependent upon how well private companies are shielded from the impact of this business shutdown. In other words, governments should do everything they can to protect companies that would be viable under normal circumstances from going bankrupt. To ensure that as few viable businesses as possible are going bankrupt as a result of this downturn, it's very important to realize that the required policy response is a transfer from public sector balance sheet to private sector balance sheet. In other words, transferring money from private sector balance sheet through private sector balance sheet from the strong ones to the weak ones, as charitable as this might be, won't work in aggregate for the economy. The required policy response is to allow governments' budget deficits to go deep negative, and ideally to finance those through a mix of slightly higher taxes, but slightly higher taxes are a private-to-private transfer, and therefore the focus should be on borrowing the money from the private sector and critically monetizing some of the required money transfer. Looking at what's been announced since the beginning of the crisis, we observe a very significant divergence in the quality and the quantity of the fiscal response in different countries. Actually, on the monetary side of the policy response, the key decisions are taken by a small numbers of leading central banks, enabling a rather swift decision-making process, especially with the benefit of the 2008 crisis experience from these central banks. On the fiscal side, it's far more complicated. It's a political process, far more countries are involved. You have state and local government issue also that play a role. And what we observe today is broadly defined three groups of countries. Some countries, in this group we find the United States, Germany, Canada, and a few others, have so far brought a policy response on the fiscal side that is quite sizable and should ensure as swift as possible a recovery of the economy. There is a second group of countries, mostly everyone in the euro area except Germany, who are nowhere near enough fiscal stimulus to ensure a swift recovery of the economy. And last but not least, there are reasons to be concerned for emerging countries ex-China, because there not only has very little been announced in terms of policy response so far, Then on top of that, their ability to borrow the required money is very limited, both in international markets in hard currency as well as on their domestic capital markets. As a consequence of the divergence in the policy response that we observe on the fiscal side, we expect in few months' time down the road to observe a significant divergence in economic recovery between those countries that have done a sizable response and those who haven't yet. This will lead probably to significantly higher cross-asset dispersion of returns, but also to a return of currency volatility, because so far on the currency side, it's mostly been emerging countries affected by falling commodity prices versus G7 hard currencies. We might start to see more divergences within those groups as a function of how the policy response evolved in those countries.